Hi, and welcome to our deep dive into the fascinating world of stockholders' equity, also known as shareholders' equity. This is the third part of the accounting equation, representing the owner's claims on the assets of the corporation. In simple terms, is what the owners have invested plus what the company has earned and kept. Stockholders' equity has three main components. Paid-in capital. This is the amount of money stockholders have invested in the company. Retained earnings. This is the cumulative amount of earnings the company has kept over its lifetime that have not been paid out as dividends. Treasury stock. We'll talk more about this later, but it's a company's own stock that it has repurchased. Let's start with the basics of stock. When a company is formed, it's authorized to issue a certain number of shares. We use four main terms to describe a company's stock. Authorized stock is the total number of shares a corporation is legally allowed to sell, as stated in its articles of incorporation. Issued stock is the number of shares that have actually been sold to investors. Outstanding stock is the number of issued shares currently held by investors. Crucially, only outstanding stock receives dividends. Treasury stock is the company's own stock that it has reacquired. It's part of issued stock, but not part of outstanding stock. Now, let's talk about how companies issue stock. A key concept here is par value. Par value is a small legal capital amount assigned to each share when the corporation is first established. It has no relationship to the actual market value or selling price of the stock. Many companies today simply issue no par value stock. When a company issues par value stock above par, the journal entry requires two equity accounts. Common stock is credited for the par value of the shares issued. Additional paid-in capital is credited for the amount the cash proceeds exceeded the par value. We sometimes call this paid-in capital in excess of par. For example, if a company issues 1,000 shares of a penny par value common stock for $30 per share, the full $30,000 cash is debited. $10 is credited to common stock, and the remaining $29,990 is credited to additional paid-in capital. In addition to common stock, some companies issue preferred stock. Preferred stock is preferred over common stock in two main ways. Dividends. Preferred stockholders usually get their designated dividend before common stockholders. Liquidation. They have preference in the distribution of assets if the company is dissolved. Journalizing the issuance of preferred stock is similar to common stock. If preferred stock is issued above its par value, we credit the preferred stock account for the par value, and the difference goes to additional paid-in capital. Let's move on to treasury stock. Treasury stock is a company purchasing its own previously issued stock, often called a stock buyback or repurchase. Why do companies do this? Maybe to reduce the number of shares outstanding to boost earnings per share, or to have stock available for employee compensation plans. Treasury stock is considered a control equity account, meaning it reduces total stockholders' equity. It is not an asset because a company cannot own a piece of itself. When a company purchases its own stock, we debit treasury stock for the full cost of the shares. Then we credit cash. This transaction has no effect on the income statement, but it decreases total stockholders' equity by the cash paid. What happens when the company later sells that treasury stock? Let's look at the two scenarios. Let's assume the company bought the stock for $30 per share and resells it for $35 per share. We debit cash for the full resale amount. We credit treasury stock for its original cost, the $30 per share. The difference, the $5 per share gain, is not recorded as a gain on the income statement. Instead, it's credited to an equity account called additional paid-in capital from treasury stock. If the stock is resold for less than its cost, the loss is not recorded on the income statement. Instead, first, the loss is debited against any existing balance in additional paid-in capital from treasury stock. If that balance runs out, any remaining loss is debited directly to retained earnings. The key takeaway is this: a company's own stock transactions never create a gain or a loss on the income statement. Any difference between the cost and the resale price is recorded in the equity accounts.